Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well. Today we sit at an important crossroads. Okay, so we got Trump being inaugurated on Monday. I think we do kind of get a portion of a trading day before he takes office. So I don't know if... Oh, wait, Monday is a holiday. Oh, you're right. Well, hold on. Let's come and look. I haven't looked to see, like, what are the exchanges doing next week? It is a bank holiday, in fact. Oh, because it's Martin Luther King Jr. Day. I see. Okay. But Inauguration Day is Monday. So this is basically the last day of trading that we get before a Trump presidency. Anything that he does day one, they will not be able to react to. So I suspect my kind of running theory here is that we will see hedging flows today ahead of the inauguration. Which probably means selling the treasuries, to be honest with you. But right now, they're kind of doing something interesting. We got an iceberg on both sides. I don't know what to do with this one, actually. I think the play usually is continue with the momentum, so we should go up. But my bias is lower. So, I don't know. We'll see. Come to the charts. Kind of look at what it's done. So yesterday... basically after we were done streaming, there was Fed's Waller speaking. And was it Waller? I think it was Waller. And he basically said that, like, the data looks good and that if it continues to look like this, that we'll have another rate cut in March. So that really shifted the treasuries around. They're not quite over this hump right here in this area, but it's looking pretty good, right? 2 really big jumps up. When we come over to the S&P 500, it was a little bit more limited yesterday, but they did move up. Oil's still looking pretty hot, but it's coming down. The Gaza deal has been signed, but you still got Russia, so Russia issue seems to be pushing oil up. We got silver and gold looking, okay, silver kind of taking a little bit of a hit here today, so risk appetite over there still not good. I'm kind of seeing some people that are like, oh man, well, it's the whole Bitcoin thing. Let's come to that in a second. Here's copper taking a huge dive this morning. The dollar a little bit of up. Yeah, I don't know, kind of hard to... The Japanese yen has been looking pretty strong though, but the market's pretty certain based on the reports that they will raise interest rates next week. So Bitcoin is going up towards 100. I saw a bunch of headlines yesterday about, Trump and cryptocurrencies. The main headline that I keep seeing is that Donald Trump is going to label cryptocurrency a national priority. But there's this other story that they will create a reserve and then they will actively purchase cryptocurrency for this strategic reserve. I'm extremely skeptical of this story, but at the same time, it kind of feels a lot like the ETF thing, where it was like, oh, actually, there is going to be an ETF, there is going to, and I was like, no, I don't think that there will be, and there was lots of reasons to doubt it, and then it did end up happening. And it almost kind of felt like that the constant leaks and headlines kind of made it happen. So that could be a thing, but And you are getting like major outlets reporting it, but Bitcoin hasn't like just shot to the moon yet. I think that we are still skeptical of the headline. Okay. But what if Donald Trump does come in and say there's going to be a Bitcoin reserve and we're going to buy X million of Bitcoin every month? Well, then MSTR is probably going to shoot to the moon, and gold and silver are probably going to get just absolutely pummeled. So I find it a little bit curious that gold and silver taking a little bit of a dive today and Bitcoin extending yesterday. All right. So that's where we're at. Okay, we are a few ticks lower here. My issue here is I do think that the trade is short. I could take a sim trade here on it, like at 25, but I do not want to sit in babysit a position today. I want to do a little bit of programming. So let's just make a note here at 25, and we'll kind of monitor it and see how I ended up doing. I got some oatmeal to eat here, so I'm going to do that first, and then we'll pull some stuff up. Today I should get fairly decent uninterrupted periods to work, so I want to get ahead of that. Will miners I suppose miners benefit from Bitcoin increasing in price, but I don't see why they would benefit any more or less than anybody else in the cryptocurrency ecosystem. So I was just answering a question that popped up on Reddit, and we were talking about this the other day, and I think that this is kind of an interesting thread because what's happened is this guy posted on Reddit. You know, he asked an LLM to create a strategy, and the LLM created the strategy. And it's not the first time that I've seen somebody post something that, like, you know, oh, make this strategy for me and everything. But the answer that this guy was able to get was like a lot more involved and so forth, and people are taking it more seriously because of that. And so it's kind of a little bit more interesting for that reason. And that way, I asked it, okay, why won't this strategy work? And the LLM gives a really, really great and complete answer as to the flaws in the sort of indicator soup strategy that the LLM created. So somebody was saying, oh, well, so what you should do is you should say, okay, so take these things into consideration and ask the LLM to fix the strategy based on those problems. Well, you kind of got two problems with that. The first problem is that LLMs do not necessarily utilize logic per se. They are accessing the logic that is already embedded in the content that it was trained on. So it's probably not going to be very good at looking at all of the different problems involved in a thing, like multiple different problems, and addressing them all with the thing. But you could attempt it, though. It would probably be interesting to attempt it. But there's a larger problem, and that is that the strategy is indicator soup. So I'm starting to call it indicator slop. And I feel like that I am justified in deriding indicator slop strategies because I write a lot of them, okay? Indicator slop is basically, let's take all of these trading indicators that I have in my trading platform, and maybe if I combine all of these indicators, I know that they don't have edge on their own, but maybe if I combine them, somehow the novel combination of them together creates some sort of an edge that doesn't exist with them on their own. Well, why would that happen? Why would it work that they don't have edge on their own, but combined together they create the edge? There'd have to be something about the way that they combine that resolves some problem with the individual indicators and creates some sort of an edge, right? But if we're talking an intraday strategy, the real heart of the issue that you face as a retail trader is that there is just not enough informational content, nor ways to really differentiate the signal from the noise in price on its own. And so analyzing that price, multiple different angles and combining them together doesn't result in a profitable strategy because there's just not enough signal there. That's why I keep trying to tell you guys, you need to add more data series. You need to look at multiple instruments and sort out the whole system, where money's coming from, where money's going to. You need to include the order flow data. You need to include the news and sentiment. You need to include what you know about various professional strategies and what those strategies are probably doing right now. And you have all of these multiple different models and you combine them together. Now you're taking a little bit of edge, a little bit of edge, a little bit of edge, and combine all of those together, you can get something that is pretty effective. And that's kind of the description of the building the strategies that I've always gotten from professional traders and, you know, places like Renaissance Capital, etc., etc. Okay. So your indicator soup is not going to work. And basically the issue that you've created is that you've kind of led the LLM into creating an amateur strategy, right? It's basically, it's going out, it's looking at all of its posts on Reddit and various trading forums and what people have tried there, and is trying to copy those. So you've basically let it into a context that whatever it generates is going to be the same retail slot. That doesn't work. What you really need to do is you need to push the LLM into a different context, right? We want the LLM to be talking about this in a professional and academic way. We want it to, instead of be drawing on the data that it has combed from forums and Reddit, we want it to draw on information that it has combed from academic articles, right? And OP, in this particular instance, is an amateur, and so he doesn't know the terms and so forth to trigger it, right? Ask it. Do you want to do an experiment? Generate a strategy based on market microstructure that so I'm going to kind of provide a contradiction for it, and I'm trying to use terms that I think are going to show up in academic journals, right? So I think that there are two words that I can use that will really, really help here is market microstructure, and another one would be statistical arbitrage that forms statistical arbitrage between the 30-year Treasury futures instrument between the 30-year and 10-year Treasury futures. Or the knobs. Try to reduce costs and avoid tendencies on speed so that the strategy So I've identified, if I try and get it to do a professional strategy, I know that it's probably going to do something that's very like scales big, right? Like you need a ton of money to do it. So I'm trying to get it to avoid that. But right, I'm using a lot of terms here. I'm telling it to trade the treasuries. I'm using words like capital, right? I'm using words that retail traders typically don't use, right? Let's see what it does. Okay, here's a market microstructure-based statistical arbitrage strategy to trade the knob spread. Focuses on reducing transaction costs and mitigating speed dependencies for effectiveness with small starting capital. The knob spread involves going long one contract and short another. This spread reflects the yield curves that shape the difference between the long-term and short-term rates. A typical spread trade involves buying or selling the difference between these for futures contracts. Key elements: data collection and analysis. Collect historical tick and intraday data for both the 30-year and 10-year Treasury futures. 2. Compute the knob spread. Spread equals the price of the 30-year bond futures minus K times the 10-year note futures. Use a standard ratio, typically K equals 3, since the 30-year contract represents a longer duration. Okay, so this is really important right here. So when I calculate the spread, it's going to be like the knob spread. Okay, it's basically going to be ZB times ratio 1 minus Zn times ratio 2, right? So like right now, I think, it's 2 to 1. It used to be like 5 to 2 or something. Like you'd buy 5 of this and or 5 of the 2-year and 2 of the 30-year or something like that, right? I think I actually got this backwards. It's a Zn mice, but I digress. It has K in there, right? So it is not describing it in the way that a retail trader would typically do it, right? It is describing it in the way that you would probably describe it in a paper. Because in a paper, you would say, well, this R1 and this R2, really these combine into one term over here, right? You already do that simplification in the math and everything. That's the way that like a mathematical researcher at the university is going to want to do it. So we're getting stuff from our LLM already that kind of suggests to me that it is trying to draw on academic papers. You see? Calculate rolling z-scores of the spread using a moving average and standard deviation. That's basically exactly what the papers that I've read on statistical arbitrage between two closely related future instruments suggests doing, is calculating z-scores and using those to determine when you're going to go long or short. Set entry and exit thresholds based on historical behavior. Okay, now that didn't really have anything to do with market microstructure. That was like entirely just like a really, really simple statistical arbitrage strategy. So now it's going to try and use market microstructure, but let's see what it does. Avoiding speed dependencies. Place passive limit orders at key levels, for instance, if VWAP recent support resistance to reduce market impact. Okay. I don't know if that would really do a whole lot, but doing your action where there's a... So if I'm a really big guy, then that would help. But like for my one lot, that's not actually going to help me. Cost reduction. Use futures with lower tick sizes and spreads. Tick value for ZB and ZN are favorable for small accounts. Focus on non-peak trading hours when spreads can widen, but less aggressive competitors dominate. See, that's a good idea. Trade in the overnight. Try it in the overnight. That might be a great way. Backtests to optimize entry exit thresholds to minimize false signals and excessive trading. Okay. Risk management. Use a fixed percentage of capital per trade to limit exposure. Dynamic stop loss based on the spread's volatility. I don't know if that would really help too much, but you see, these are things that like, it's like I have $1 million, but I am trying to limit my capital. Okay, but if I'm just only have enough to trade like one contract, I don't know if that really helps. Implementation outline, single generation, monitor real-time tick data, calculate z-score, execution, enter a long, short position in the spread, use a spread order type or a custom execution algorithm to ensure balanced entry, close positions once the z-score mean reverts, use time-based exits if the spread doesn't converge within a reasonable period. Enhancements. Use a Kalman filter for dynamic hedge ratio. Instead of a fixed ratio, use a Kalman filter to dynamically adjust the hedge ratio based on changing market conditions. Okay, I don't see how you would use a Kalman filter for that, but you can see that it is trying to pull information from an academic study. Because retail traders don't typically talk about Kalman filters. That's usually not included in your platform. In fact, I have a Kalman filter in my indicator suite, specifically because it's something that I see pop up in these kinds of papers all the time, and like retail traders never talk about. Okay, Volume-weighted indicators leverage microstructure signals like order flow imbalance or volume clusters near support and resistance. Well, I think, but generally overall, though, its approach there is pretty good. It kind of wonders. So, like, it's basically saying, I have a moving average, right? And then I'm saying, how far away am I from this moving average, and generate a z-score to represent how big that deviation is. Isn't that just MACD? But I don't think I've ever tried applying those sorts of concepts to the spread itself. So I kind of wonder if it's maybe misplaying. Well, I don't know. You know what? I saw something yesterday that I need to read. Well, while I'm thinking about it, let me go find it. Because I saw somebody post a study on LinkedIn. Here we go. I think that this one is probably too involved for this stream. Statistical arbitrage in commodity futures. Statistical arbitrage offers a systematic approach to trading by leveraging the mean reverting nature of price relationships between closely related financial instruments. This article presents a case study on Brent and WTI crude oil futures, two globally significant benchmarks, and demonstrates how statistical arbitrage can be used to exploit their pricing inefficiencies. By modeling the spread between these futures and implementing advanced risk management techniques, we develop a robust trading strategy that delivers risk-adjusted returns. This article aims to provide readers with a detailed roadmap to build and optimize a statistical arbitrage strategy in the context of commodity trading. But when we come down here and I kind of browsed it really quickly, modeling the spread, what is this intercept? The regression approach allows us to calculate a hedge ratio B, which adjusts for any relative price scaling between Brent and WTI. Okay, so there's a key element that the LLM didn't give us, right? It's saying when I have a spread, I'm going to have Brent is going up and crude is going up as well, but maybe not as quickly, right? And so if I'm trying to do this statistical arbitrage sort of a thing, yes, I should be able to make money off of the fact that they're going to go up like this, right? And this is going to go up like this, but there might be subtle little differences between them where this one is out of line with this one and I can bring it back into line with it and make money off of it. But I have to account for this widening spread, essentially. So the way that they're doing that is they're using regression. So they're basically saying, okay, here's this, the chart of that on the spread itself looks like this, and I create a regression line and say right now it's going up like this, so I have to account for that. Okay, cool. B equals 1.0120, indicating that for every unit change in WTI, Brent adjusts by 1.012, and the intercept equals 3.7406, representing a baseline offset between the two prices. Oh, okay, that's not. Okay. That's maybe not necessarily what I was saying. That's just like a kind of a simple, like, it's a little bit different from the spread that I do though, right? Okay. Oh, and look, they have some code, some Python code. Oh, I love it. I love it so much. I don't love the font that you used for Python code, but I love that you included Python code and that it's colored. Very lovely. Okay, statistical tools. Z-scores. Huh? Yeah. Z-scores allowed us to standardize the spread, making it easier to detect significant deviations regardless of its absolute value or volatility. Okay, so Z is the spread minus the spread mean divided by the spread standard deviation. Is the spread mean a moving average? Yep, it is. See, they give, I love this. Because they gave us the Python code, we don't have to guess what they mean by that, right? Okay, spread mean equals data spread dot rolling. This is a method that you can use in pandas to create a rolling window on something. And they have a rolling window. In this case, the rolling window is 252, which I think that they're using. So the interesting thing here is that I would have thought that if you're doing statistical arbitrage like that, that you would be doing it on like really short time frames. But the number 252 comes up a lot because that's close to the number of trading days in a year. Right, there's not 365 trading days in a year. That's how many days there are in the year. You have to take out weekends and holidays and everything, and then it comes out to around 250. Okay. One place where you will see this come out is that they say that like the way that you scale for time frames is using a square root. So like, if I want to scale between a daily time frame and an intraday time frame, then I use the square root of 252. And that's the amount that you scale it by, because it's the number of days in a year, the square root of that. Okay. That for instance, if you wanted to do something like, okay, like some people were saying, can you tell the difference between a 1 minute chart and a 1 day chart? Are there statistical differences between them? Information that I have suggests that you should, but it's not something that I've done. One of the challenges that you're going to have is that if you just take the straight charts and I'm, if you're just looking at a chart, your software kind of scales it and everything, right? But if we're looking at it from the data, it doesn't scale that. So we're immediately going to see that like the average range of a single bar on the daily bar is significantly higher than the average range of a 1 minute bar, right? So what do we have to do? We have to scale them, and what would we do? We'd use the square root of 252 to do it. Okay, fair enough. Rules for entries, exits, and holding periods. Statistical signals are only part of the picture. To minimize noise and overtrading, we introduced additional rules. A volatility filter. Signals are only valid if the daily change in the spread exceeds a minimum threshold, ensuring trades are based on meaningful price moves. Yeah, they're saying most of the time it's not really moving and we don't want to trade the least volatile stuff. And that's interesting because usually in my algorithms, I do the opposite. I usually say if the change in the, well, I've never done it with a spread, but if the change in the instrument that we're doing is over a certain amount, then it's too volatile and the strategy tends not to work, which tends to happen for a lot of strategies, by the way. So volatility filter is a really good component to add into your strategies. Okay. Minimum holding period. Positions are held for at least 5 trading days. Okay, so that confirms to us that this is doing it on a daily basis. Interesting. Positions are held for at least 5 trading days before reevaluating signals, reducing frequent position flipping and transaction costs. Okay, so this is interesting. Is that this is not something that I have tried, but maybe we should add into it. It's like, I might have a strategy that, let's say that I have a strategy that's like, when this moving average when price crosses over this moving average, I want to go long. But what happens if price is constantly crossing back and forth across the moving average? Then you kind of have a problem because it takes a ton of trades. And so the way that there's kind of a threshold problem, essentially. And many strategies will have this issue where you're using a threshold to determine when you enter into a trade. But if you enter a market period where that threshold is crossed over and over again, you have an issue. So what they're saying is you're not allowed to get out until it's been at least 5 days. Then you can look at the other information and get out based on that. I really like that there's at least a minimum holding period. Okay. I like it. Dynamic thresholds are used for both stop loss and take profit levels scaled by the spread's rolling standard deviation. Okay. So they are going for 4 times standard deviation on their profit and 2 times standard deviation. Okay, so they're looking for an R factor of 2, but they are basing their stop loss and take profit on the standard deviation of the thing. Okay, this is common. This is actually exactly what we were talking about in the last interview with Andreas. He was saying, okay, so like, what do you base it on? Volatility. And he was saying, well, usually you use standard deviation, but in this case, it doesn't really matter. But so, yeah. Instead of like, a lot of the things that I've done has been, what is the ATR of this instrument? And use the current ATR to determine my stops and targets. But he's saying that actually, like, standard deviation tends to work better. And in this study, they're using that. They also change their position sizing based on that. Okay, so that way, their average profit is going to be the same. Like, increased volatility for this does not result in larger winners or losers, because they size down essentially when that's happening. Something that we can't really do, and I don't really mess with it in my strategies, but I have looked, like, I do look at that in the momentum strategies. Right? During periods of low volatility, larger positions can be taken due to reduced risk, and during high volatility, position sizes are reduced to avoid excessive drawdowns. The only problem being, when you go from a period where you have very low volatility immediately into a high volatility, it doesn't adjust that quickly enough and it gets screwed. Okay. Performance evaluation. The following table summarizes the key performance metrics of the strategy. Over what time frame? Well, it doesn't tell us, because it only made $148. That's kind of a little bit weird. That's not very much. And how big would they have to have been trading to have generated that? Like, what is the starting value of the portfolio? But the Sharpe ratio is really good. Okay. So they have done it from 2015 to 2023. So, what, 8 years? I don't think that that's enough data. Not for a daily strategy. Not for a daily strategy. But you know what? They did a pretty good job. And I think I understand that. I wonder if we can get it to work on the treasuries. I think that we should shelf that, though. And do that next week. Okay. Anyways, the whole point of that was, if you're going to use an LLM to help you generate a strategy, here are some kind of tricks that you can use that will lead it towards perhaps a better strategy. But you can see that there's still problems with it, right? It simply does not come anywhere even remotely close to replacing a trader that has studied this stuff and knows what they're talking about. Kind of the problem that I have with LLMs in general is that I really don't think that it is replacing people's jobs. You know, they did a study. Oh, who was the people that did this study? I can't remember the name of them, but they basically tracked like they basically tracked what has been the change in developer productivity by utilizing Visual Studio Copilot. And they found that like the metrics on overall developer productivity were kind of like mixed. Like it didn't just like, I think that people kind of expect that it's like, if I write 100 lines of code a day on average, all of a sudden I'm going to be putting out 500 lines of code. No, it doesn't seem to work like that. Because the answers that the LLMs give you don't work. Like, it gives you like a starting place, and then you kind of have to like adjust and debug their code and so forth, right? But what they did find was that the number of bugs increased 50%. So like in the coding world, at least, it's not really helping you. Companies are kind of using it as an excuse to not invest in their workforce right now. But here's the thing. Almost everything that Mark Zuckerberg has been like, we're all in on this thing or whatever, has ended up being a bubble and a dud, right? Like, we're all in on the metaverse and that was a huge disaster, right? It's all of these sorts of things, and it just really feels to me like the current bubble is AI. And I don't think that AI is going to go quite the way that people think it will. I don't think that LLMs are really capable of doing the things that people think that it will. You need additional major developments beyond that you're not necessarily going to get. And the developments that you are likely to get actually lead you in a different direction, right? If I was CEO of a company right now, I would not be saying, we need to put as much money as we can into developing these LLMs and using OpenAI's products and blah blah blah. I mean, like, it's too simple. That's like well, it's exactly the sort of move that I would expect a CEO that's not technical and doesn't really understand these things to make. What they should actually be doing is they should be investing in data engineering. They should be investing in all of the data that we generate within our company. We are saving it. We are saving it in forms that we are easily able to put it into machine learning algorithms so that we can analyze that data and find, optimize certain things with it. That's where the investment should be going, which means, by the way, hiring data engineers, because the people that like do the modeling and stuff are usually have a different set of expertise from the people that like manage the data pipelines and make sure that the data is there. Yeah, that's where they should be developing. So that's kind of the interesting thing about the exercise, and it just kind of shows you, if you're trying to do that, is that the LLMs don't really work completely right now. Like, I can't just say LLM, make a profit, make me money on the stock market, and then have it go out and it's going to come back and give you $1 million. It doesn't work like that. There's too many issues with it. Like even if it came up with a good strategy, it trying to apply it, there's like little errors here, and they just kind of compound on each other until you get something that's just completely out of control. By the way, I said 25, didn't I? 10 ticks. That's not bad. I would say that given the amount of action and change in cumulative delta and everything else that I'm seeing, where we're at relative to the overnight market maker positioning and everything else like that, you could say that I was just dumb luck, but hey, it worked. If it works, it worked, right? In that instance. But we are at the seller's cost basis at the moment. So we'll see if they're able to extend beyond this. I suppose that 20, it does become one spot that I might want to look for like an exit, but I'm not getting the liquidity hole kind of thing down here yet, am I? So I think that there's a possibility that they continue through, but let's see. They might stop here, and then we'll start to see the hole, yeah? Luigi, okay. Back to yesterday, I caught a bit of your rationale as to why the point of control develops on a profile and how it has nothing to do with the common theory of the most agreed upon price. However, ... Okay. I should have waited until he posted his second comment to read it out, because now we're all waiting here. And when I do it again, I'll have to read the first comment anyway. My bad, guys. I think I'm gonna start a sneezing fit here. My nose is really starting to itch for some reason. Maybe it's just dry. I need to drink more. Okay, Luigi says not... Okay, so let me go back and reread the thing. I caught a bit of your rationale as to why the point of control develops on a profile and has nothing to do with the common theory of the most agreed upon price. However, If price still consolidates at or near that level, wouldn't it still be helpful information to keep me out of a bad trade entry regardless of the reason that it forms? So, kind of yes. I mean, the way that we primarily use it is once we detect the conditions that create those. So again, the kind of the issue is if you skip over a price or like too much volume happens too quickly, that's what kind of will create that hole. So if I see it go through a place really quickly and then come back to it and they're not putting much liquidity up, like right now we've got a trend going and I'm kind of like, I'm not seeing the hole, right? Well, part of the reason for that is that it's like 3,000 by 3,000. Well, okay, now we saw it at now we saw a big one at 19. What I'm going to be watching for is if we tick back down to 19, do they put up a lot of liquidity for it? Or is it going to be like less than 500 contracts? Right? That's what kind of causes it to form. So we can see like the beginnings of it. And what often happens is, that kind of action is the thing that ends up being like the trigger, pushes the retail, the guy that, oh, there's this trend and it's been forming, it's been going, and I really wish that I was getting on it earlier, but now it's really accelerating, and that's really the thing that makes me think that like this is going to continue, right? And basically what happens is everybody kind of getting triggered at that point creates the liquidity hole and prevents us from moving on. So if I really strongly believe that it's like a trend 8 and we're going to move down, I'm not going to get in there. I'm going to wait for a pullback, or I'm going to wait 45 minutes because that's about the amount of time that it takes for the hole to heal, right? Before I do anything, because I know once a hole forms that we're likely to stay in that area for a long time. So I think that your approach there is similar to what I do, which is I use it to avoid bad trades, right? But that is not generally how the volume profile people look at it. The volume profile people look at it as like, this is like a key signal of whether this is a fair price or not. And I can use that to determine, price I can take for the next big move or something like that. And it doesn't really work that way. And so when you get some of those things, like a good example is we'll create that kind of thing, and the person starts to say, oh, I can start taking mean reversion trades against this. Or maybe they're going to retrace that range extension now, right? And the trend continues through them, right? Because the formation, they read that formation of that as, oh, okay, they found the price that is acceptable to them. But that's not what's happened. It's just a hole that's been created. And maybe there's a guy out there that needs to buy 60,000 contracts. So it's like we move down on 10,000 contracts net. So he's able to pick up 10,000 contracts on that move down, right? And then in the liquidity hole, you're able to pick up just as much, if not more, maybe 15,000 contracts, right? But if he still has to buy 60,000 contracts, it's not anywhere even close to done, right? So if I know that, I'm going to be looking for the continuation later, right? And so that's just kind of like one of the major situations where I see the volume profile kind of gets it wrong. Uzi says, wow. Wow, what? Wow, the pushed back down there? So I don't know if this is really the best location to get involved, because there is a little bit of a sign of a liquidity hole at 20 now. But I think that the action is really starting to confirm my theory that because it's the last trading day before Trump, that the hedgers worried about inflation are coming in short today. Huh? I think that before I said maybe I was just lucky. Now I'm really feeling like it was a good call. But of course, that doesn't help us going forward. Do they continue? Or is that all there was? Usually when I start to see any kind of a sign of a liquidity hole, that's where I get out. So I guess I would be done, and it wouldn't matter to me if it goes further or not. By the way, we have been seeing some significant movement in the dollar. Interestingly enough, not necessarily correlated with the treasuries either. The Japanese yen is falling and the dollar is falling. That's really interesting. And we're still only like 5 minutes into the S&P 500 going. Okay, now you mentioned that it takes approximately 45 minutes to repair that hole. Do you have any data on how far price needs to get from the point of control, for example, where it is safe to enter? Okay, so the way that you would look at it is this. Okay, so first of all, let me explain the 45 minutes thing. So the impact of a large order tends to follow a square root law. So that means the impact. Get a slightly. Grab my pen. The impact of an order of size Q is equal to Y, which is a scalar unique to that instrument. Basically, what you do is you track the impact of large meta orders a couple of times and calculate Y. Okay. Omega, which is the volatility of that instrument, times the square root of Q over V. Okay. Follows the square root law. So that means that if we trade 50,000 contracts and it moves the market yay much, trading 100,000 contracts twice that much does not result in the market moving twice as far. It results in the market moving 1.4141, the square root of 2 times as much. Okay. So when you graph it out, it looks like this. At first, it appears linear, and then very quickly you realize that it's the square root. And of course, this is a function that goes off until infinity, but like in practical terms, there's kind of a ceiling. Now, there is a point at which you bust all volatility, like all of the market makers panic and go out, and then the impact of it is like increases exponentially. Okay, you don't want it. So if you're a big guy, you don't want to do that, right? You're executing a large order, you stop before it gets to this point, right? You don't want that. That will screw your trade up. Okay, bad. Okay. After the execution finishes, there will be a short-term regime change, mean reversion, like this. Okay. And this follows a 3/5 law. So instead of it being the square root, it's, this whole thing to the 3/5 power. Okay. That's this decay function. Okay. So what it looks like to people on a chart is, right? This is the impact of the mean large meta order, and this is the mean reversion period. But if you actually look at it and you're on a thick enough instrument with enough granularity and everything, what you're actually going to see that it looks like this. Okay. So why does it do that? Well, what has happened is, as it moves up, it's killing all this liquidity. It's not killing, it's filling all of this liquidity. So essentially, there is going to be more liquidity above us than there is below us. So when they stop executing, we tend to fall back a little bit. Okay. So when you take this 3/5 law and you kind of extrapolate it out in terms of time, yeah, basically what it comes out to is, if this is X and this is Y, Y tends to equal about 2.5 times X. Okay. But you don't have to sit down and say, okay, how long was this initial drive and at what point did it stop and all of those sorts of things, because X tends to be about the same every day. And so the real result of it is that it tends to be between 20 and 45 minutes. Okay. So if you're having a problem where it's like, I get into a trade and then immediately when I get in the trade, it seems like the trend stops and it's going against me, or it goes nowhere, even though it's like a trend day, you know, like maybe you had this problem yesterday, you have a loser, wait 45 minutes before trying again. And then you'd be sure that you're in a different enough market that you don't make the same mistake. Okay. So that's why 45 minutes. Okay. So this results in another kind of thing. And this is this is kind of the big secret. Okay. Like this is the one that they don't always tell you about. Okay. Is that if I have a large meta order and then immediately at the strongest point of impact right here, basically what it means is that you know, you're buying. The more that you buy, the less that the impact of that individual buy has. But meanwhile, the impact of a sell ends up being stronger because there is less liquidity behind us. So if I come in here with an equal and opposite meta order, that is the size, the Q1 and Q2, we're going to say here, we're saying Q1 equals Q2 in size. Q2 will end up having more impact. And so here's like the short-term regime change after this, right? You're going to get this. Okay. This square root law kind of ends up becoming like a universal speed limit for markets, right? Can you imagine if you were able to do it where like Q1 and Q2 were the same, but Q2 didn't have as much impact, then you'd get this, right? And that's a profit, right? You would be able to make money purely from your execution. But because of this square root law and inverse square law, or sorry, the square root law and the inverse meta, or I don't know what you want to call it, but basically if I buy a ton of something and then immediately sell a ton of something, it will tend to result in a net loss. Okay. So that kind of gives us some guidelines that we can kind of use to judge these sorts of things, right? So if it comes up and it comes down to here, right? I want to identify this point right here and wait 45 minutes for this to occur. And then if I think that there's going to be a second leg, it's going to go up like this, right? And generally speaking, this Y right here, like the change in price, and Y2, like Y1 is going to be bigger than Y2, right? Because it's still, even though like the liquidity is recovered, it's like, it makes it harder. It pushes less and less and less as it goes along, right? So I can kind of use that to judge some things, right? If we just had a large move, I'm seeing this liquidity hole form, right? And then I start to see aggressive orders pushing the other way. That's my favoriteest thing in the world to happen, especially if I had some reason to expect that those orders were going to come in, because that's the thing that results in this, right? You get this huge move come back, right? Like a good example of where this might happen is, say you had some sort of a large economic release, right? Like what we had yesterday, CPI, or the yesterday's report was retail sales, right? And it was dovish, but then Donald Trump comes out and he says, oh, we're absolutely going to have tariffs, and they're going to be the biggest tariffs ever, right? And that's inflationary. That's going to scare treasury holders. They're going to sell it, right? So here you've got something it's not just like counter to a move that just happened and damaged the liquidity below us, but it's also like a super major thing. Yeah, that's going to have huge impact. Super great trade if you find those. Conversely, if we have a move like this is starting to happen, and they take off before the 45 minutes, or like they only wait like 10 minutes, that kind of tells you something really important about the market. Like that is one where like they are so behind, they are chasing this so hard that they can't wait for their impact. This is a market that is likely to result in a trend day and or become unhinged, right? This is where you can start to get these days where it just goes like all over the place, right? It's telling you some stuff, right? Because again, I can look at the move and I can see the liquidity below us is damaged. There's going to be more liquidity up here and less liquidity down here. So you can kind of start to draw it on there, and you can start to say, okay, like all of the liquidity down through this area is kind of less. And you can think of it as time goes on, more limit orders willing to come in and place orders at that place will come along, right? And you just kind of assume that after 45 minutes, that area is normal again, right? So that's where it's kind of like, okay, so in a way, past price movement can actually kind of predict future price movement. It's not that it's like a predictive thing per se. It's like, because you still have to predict the meta order, right? And you don't know if the next order, large meta order, is going to be long or short. But if we know what the next meta order is, we can judge the relative impact that is going to have on the market based on the timing of the trade and the liquidity conditions, essentially, right? And so there is kind of this thing where it's like, if you have something that it goes and it like immediately pulls back more than 50%, that's something that's like, or even better, I can see. So again, it's like we're seeing this thing and we're seeing this thing. Okay, what I'm going to see in cumulative delta is cumulative delta coming up like this, and then cumulative delta coming down like this. And I can kind of basically look at this point and say, well, we've gone beyond the point where I think that this is just the mean reversion. Because if this is the mean reversion, it would be going sideways like this. If not, maybe slightly up, but just not up quite as quickly, right? So there is kind of a threshold at which I can kind of say there's enough evidence to suggest that we are getting a counterflow now, which is really kind of what you're asking about, right? I can almost stretch that square root market knowledge to explain the movement. Yes. I mean, I think that is why Elliott waves happen. Is that so the optimal way to execute is for somebody that's doing a really large portfolio transaction is get to the point where your impact is straining the market and you're starting to get this, and then back off and execute in this hole. And then once the liquidity has recovered, it is now in your interest to push it again. And you do it and you push it again. Now, we were talking about this in the interview. Like they say, Elliott wave theory, that's like 1, 2, 3, 4, 5, and then on downside is 1, 2, 3, right? But in treasuries, I usually don't see that. In treasuries, it's like 3 is a lot. So I don't know. It seems to me that Elliott was like making a real observation about markets. Is just that like they always kind of go a little bit too far, right? Because they have this thing that's like, okay, if we've seen wave 1 and we've seen wave 2, then we should see 3, 4, and 5. And then they take the trade off of that. That's flawed, because the only way that you know how many legs there are going to be is if you know the total size of the meta order of the thing that they're executing. Now, there are some situations where you can kind of know, though, because, you know, like maybe it's the end of the quarter and you know that there's rebalancing, and there's these models that people have that basically estimate how much money they have to rebalance. And you can kind of look back on past moves and use your experience to basically judge, like, what is the net change in cumulative delta that I need to have for this move to happen. And, you know, if like an average in the 10-year, something like this is between 10 to 20, or it's 10 to 20K, right? So I know if we had a piece of news or a rebalancing that is like in the 50 to 60K range, right? Then I know that there's probably going to be 3 waves. So also, by the way, why kind of part of how I use the cumulative delta is in some instances I'm using cumulative delta to determine my exit. That I can look at, and that's probably what I should have done like yesterday. So I should have said, well, this is such a big shift, though, or on CPI day, should have said, this is such a big shift. There hasn't been enough change yet. I think that they should go further. Cumulative delta as the change in cumulative delta as an exit signal. So that is essentially what we know about market microstructure and liquidity, and how Seth tries to apply it to his trading. Right? Like a thing that like there's a square root law in that formula, that's well proven. Right? The thing about like doing it in waves, there's some literature that you can read out there about that. The rest is kind of like how Seth tries to apply it, which is maybe not necessarily proven. Okay. Have you read W.D. Gantt? I don't think so. This is technical analysis. Gann angles. The legitimacy of Gann's techniques have been seriously questioned. Calculating a Gann angle is equivalent to finding the derivative of a particular line on a chart in a simple way. Oh yes, I am familiar with this stuff. This is the one where it's like where you have these chart tools where you have 2 points and you go from here to here, and then it will say, okay, here's this angle, and then there should be from here there should be these other angles. And yeah, sounds like nonsense to me. I know. Like here's the larger thing that you can kind of take from what we know, okay, is that what really moves things are the orders. Price is kind of unreliable. So you get this sort of a thing where it's like, we had a big move, or we had a lot of volume selling, but it didn't go anywhere. And then later it moves down on not a whole lot of volume. What's with that? Well, there could be like a correlated asset, things like that. Like what matters is the way that the orders are interacting. And in that situation where it's moving down on not a lot of market volume, that means that the bids are just kind of canceling in front of it, right? So what matters is future orders. Why are people submitting orders? And the typical retail trader conception of things is, well, I'm submitting my order because it has reached a point at which it has now moved far enough for me to say that we're like in a good trend, and a trend that's likely to continue, right? And that's the retail trader's conception of it. And so the retail trader kind of assumes that like everybody thinks that way. But the problem is that the biggest players in the market don't think that way at all. Okay, who's the largest player in the market? It's the index funds. And how do they function? They say we had X million dollars in contributions this month, X million dollars in withdrawals this month. Also, this stock moved more than this and less than this, and we're supposed to rebalance it every month. So that means that I have to buy X million of this, sell X million of this, etc., etc., etc. They have to do that. It's like legally required for them to buy or sell a certain amount. They don't care what price it's at. They don't care what pattern it went throughout the day or anything like that. One way or another, they are going to buy that X millions of dollars in that asset because that's what's required for them. Okay. We call this, the term for this is they are price insensitive. They don't care what price it is. They just have to buy it. Right. So they're not looking at what the price had done in the past to make their decision at all. But they are submitting the orders. So that's the situation where we can potentially predict their orders and the impact that their orders will make on the market and have a profitable trade. And what is the predictive piece of information that we have? How that fund is going to have to rebalance, and that it's the last day of the month, and so that's when they're going to do it. So is our knowledge of that particular fund's strategy. See? So the thing that's predictive, we do have a predictive piece of data, but it has absolutely nothing to do with the intraday price. See what I mean? Right? So we want information that predicts orders. And it's just kind of like the case that like what predicts orders generally has very little to do with, you know, past price movements. Now, when we get onto daily charts and we're looking at things like momentum and mean reversion, and then there are kind of properties that you can look at to kind of help you predict orders in that direction. Okay. But just like what it's done on a 1 minute chart, just ignore that. Just ignore that stuff. And these things where it's like people are drawing lines and there's a support level and we based on what the range of yesterday was and these certain Fibonacci levels, here are some key levels. So it's just ignore all of that stuff, okay? Because the people that are really executing, they don't care. They don't care. It's either there's a large meta order in the market, in which case they're just going to bust through that level, or there's not a large meta order in the market. The market maker is just trying to make a market, and they can utilize those kinds of levels to kind of get retail traders excited and into trades so that they can work their magic, right? So basically anything I look at that people say that's like, you know, something that's been developed in the past 100 years that's based on the technical analysis of a chart, I basically ignore. Unless they have empirical evidence. Gann's technique of bar counting swing lows and highs is a I don't know what yet, but we need data for it, right? I don't care why something works. So the reason why you should care why something works is because when you really understand it, it gives you really good information that can help you direct your attention in the future. Okay. So like that's exactly the problem with volume profile, is that because people don't understand correctly what causes it, they have all of these other theories based off of it that are complete nonsense and don't help you. And people spend all of their time studying those concepts that are useless. When you really understand the microstructural reasons for why that happens, you can kind of just say, oh, I don't need to pay attention to this. This isn't useful. But that comes to my other big pet peeve, which is we as humans are not capable of looking at enough data on our own to determine that something works or not. This idea that I'm going to go and I'm going to add some indicator to the chart, and then I'm going to watch how the market reacts to that chart, and I'm going to notice some sort of tendency in the market that I can then exploit for my trading edge. Once you really understand the numbers and statistics behind a fat-tailed market and everything, you realize that this kind of scenario is a fantasy. It doesn't work that way. If you are not doing it programmatically with really large sample sets, then the information that you are gathering is useless. Well, okay, so maybe it's a bad analogy, but as to why I don't care about the why, it's akin to I don't need to know the inner workings of a car engine, why pistons fire, etc., to be able to drive the car. Well, I think that this is actually a perfect analogy, because I think that you are extremely unlikely to become a champion F1 driver without understanding things about how the car engine works. Those guys understand how it works. They do, right? Like Senna, who's kind of considered like the greatest F1 driver of all time to some degree. He knew everything about those cars, man. He was like, do this, do this, do this, change this. I feeling it, driving. We have this problem. Here's how we can try and solve those things. And that's part of what made him such a great F1 driver. Like, kind of the whole thing here is that now that we understand why the market behaves the way that it does, it gives us really good clues as to where we can look for edge and where it's probably not really very useful for us to look for edge. Most retail traders think that, I'm going to spend as much time as possible looking at charts and adding indicators and doing all of these technical things, and that's what's going to find me success in the long run. But what we know about markets suggests that that's stupid. It's not stupid, I guess, but it's not going to work. You're not going to find edge that way. What should you really be looking at? What causes large institutions to buy and sell? How do their strategies work? What kind of news is in the market right now? How does, what are the current liquidity conditions? Those are the things that actually matter. And like what the 1 minute history of price is doing, and like whether it's a doji or it doesn't help you. Doesn't help. No. Haven't you watched those movies with Senna where he's like, he comes. So I think it was like when he started with Ferrari immediately, and they're like, he drives it and he says, well, the car is too heavy. And they're like, yeah, we know that that's a problem, but like we've done everything that we possibly can to try and make it lighter. And he says, oh, okay, well, did you make this out of magnesium? Did you do this? Did you do this? Like he knew all of these things, and like within a week, he had completely changed the whole car. And then the big bosses come down and are like, oh, thank you for giving us all of this. But we're going to treat you like shit. And he's like, no, I'm in charge because I basically am the one that provided all of the edge for your car. So you need me. Yes, if the engine blew, could he go and probably actually? I mean, it would take him a long time all by himself, but like some of the best drivers were also like the expert engineer on the team. Right? Of course, it's a team effort, so you got multiple engineers, but they were advanced engineers that were kind of coming up with the ideas. And this is the same thing in that movie about Ford versus Shelby. The guy that was the driver that was kind of a hothead. He knew the car. Do you track immediate liquidity? So you're using a term there that like is not clearly defined. So I mean, I track resting liquidity. I also kind of have ways to try and track latent liquidity, but I'm not 100% sure what you're going to define as immediate liquidity. I highly doubt that every F1 driver has that knowledge. So like the F1 driver that doesn't know anything about the way that the car works and has never worked on a car, yeah, I don't think that they exist. To be honest with you. But like, so again, let's come back to this whole framework that we have, right? We know that orders have impact. And we also know that it follows the square root law. So to review, the impact of an order of size Q equals Y omega, which is the volatility of the instrument, times square root of the Q, the size of the order, over V, which is the volume during that period. Let's say that Q is 1% of the volume, or 0.01 V. 0.01 V. Okay? So we get over here the square root of 0.01 V over V. So what happens then? The V's cancel out and we get the square root of 0.01. Okay, class, does anybody know what the square root of 0.01 is? This is where you get this kind of weird thing that, like, because I think some people might think, oh, is the square root of 0.01 0.001? But because it's a number less than 1 square roots, it goes the other way. So the square root of 0.01 is actually 0.1. So what are we actually saying? Right? So you get y, the scalar omega times 0.1. We're saying that 1% of the volume is responsible for 10% of the change. 1% of the volume is responsible for 10% of the volatility. That's what the square root law means. Or another way of putting it is when you're looking at this curve, right? These orders right here have a stronger impact on a per order basis than these ones do. Right? The more orders that are going in one direction, the less that the market starts to discount it. Okay? So what this means is that the market reacts to orders is much more sensitive than we realize. And this is demonstrated really well in this inelastic market hypothesis paper that was released a couple of years ago, where they basically said, let's take $1 and take it out of bonds and go and put it into the stock market. What does the overall market cap of the stock market change? And you would think, oh, well, we put $1 in, so the market cap should, reflect the total value of that market, and you've added $1 of value to it, so it should only go up by $1, right? But what they found is that it actually goes up 5 to 8 times. But $1 in, market cap goes up $5 to $8, right? The market is very sensitive to the orders, and this is why they say it's inelastic. Like, elasticity is kind of like, as we have a change in supply and demand, how does, or when we have a change in price, how does supply and demand change, essentially? So like if we move up, then that should give an incentive for suppliers to produce more of that thing. More supply will come in and that will push price back down. And so it's like a rubber band between my fingers if it goes too far away, and then it will kind of snap back, right? That's elasticity. So what's inelastic? Inelastic is like, I move my fingers apart and that rubber band just stretches. That's inelastic. That's what financial markets are. Okay. So this makes it extremely easy for the markets to arbitrage out any kind of inefficiency. So if I find a tendency in the market, I'm going to go and I'm going to start trading in it. And as I trade it, that will remove the edge. Or to put it another way, if we're here and I know that at a certain time, that price will be here, okay, I can kind of sit there and say, how many contracts should I actually buy? Because I can calculate that using that formula that, the impact, right? And so basically what they do is they say, what is the optimal number of contracts to get us to here? Because if I go too far, and trade to here, then when it comes to that price, I'm going to make money on these contracts, I'm going to lose money on these contracts, and I actually haven't made as much money as I could have. So I kind of need to figure out what the optimal number of contracts is, right? But then that's the whole thing is that because I know that, once I've traded on it, I've removed that edge from the market now at that point, right? And that's where you get into this issue that if I have a signal and it says buy something, and then I act on that signal, right, I'm going to move the market. And you would say, well, but you're a teeny tiny little retail trader. Sure. But you have a profitable strategy. You're not going to be a little retail trader for very long, right? It's going to work, and it's going to keep working, and you're going to get to the point where it gets to there. Now, if you're the only person that's doing it and you know what you're doing, you can basically calculate what the right sizing is and not go beyond that. That's why Renaissance Capital has a limit on how big they will let their fund get. It's because they know that if they trade it with too much size, it ruins the edge. And so they're trading with just enough to optimize their profit, but not tip the rest of the market off to that edge, right? Okay. So any kind of a pattern that I can just look at a chart and see, everybody else out there is looking at a chart and seeing, and they arbitrage those things out very, very quickly. Very, very quickly. So, how do you find an edge? Basically, the issue here is if I'm going to go and I'm mining for gold, and I'm just go and walk out across the valley floor and try and pick nuggets up off of the ground, well, what I'm saying is this is already a populated valley. There's people everywhere. So any nuggets that were just sitting on the valley floor have already been picked up. How are you going to find gold? You know a few things about geology, and you know where gold is likely to form so that you can go and find the streams and the places in the streams where you know to look and pan for gold. Right? You have to know what you're doing. You have to understand why the market does what it is. The approach that I'm just going to trade this as a black box, you're never going to find edge that way. You're just not. The edges that would allow you to just kind of not have any clue what's going on and observationally find the edge, they don't exist anymore, just as far as I can see. I don't believe that they exist anymore. I don't see any retail trader finding an edge that would be trading with enough size for a big institutional trader to even notice. Were you not paying attention when the whole GameStop thing happened? You not been watching it? Like the past 4 years has basically been case after case after case of extremely large moves being created purely from retail trader hype. You know, the real issue is like if it's a public strategy, right? If I discover an edge, if I discover a technical systematic edge and I program it into my robot and I'm taking advantage of it, I'm not going to tell you guys, because I know that I can calculate there's an optimal size, and I'm going to basically size it up until it gets to the point that you know, I've kind of calculated it should be that, and that the market is not noticing, right? And then maybe back off a little bit, right? So that edge is preserved. But if it's a public thing, then there's nothing you can do to stop somebody else from trading it or saying, you know, like if it's two of us, then we can make an agreement. We can say nobody can ever trade more than X contracts. I get half of the edge and you get half of the edge. Right? But if it's a public thing, they're always going to go overboard. They're always going to go to the point where, again, we know that it's going to be here. Oops. Oh, that's weird. They're always going to go to that. And then it's a loser. And like the whole thing at that point is, maybe it's a structural inefficiency. So maybe this always exists. You're only going to make money if you get in it early enough. And at that point, there's going to be all of these algorithmic traders, all of these sorts of, you're not going to be able to get in. You're always going to end up being over here where you're too much, right? Don't single out a generational anomaly. What? Well, but it's perfect evidence of that retail traders can move the market. Like that's the thing, is that like, okay, you come in and here again, it's a square root law, right? It's a square root law like this. Okay. There's somewhere along here, there's an amount. So X is the x-axis equals number of shares, and Y is change in price, right? At what point is this the minimum tick size, right? That is to say, how much size do you need to trade in order to move the market the minimum tick size? And I'm telling you that Q is way smaller than you think it is. Way smaller. Basically, like what you think is going to be enough to move the market one tick, divide it by 8. And that's probably actually the reality. Let me give you another example. I showed you this on that trade. Let me see if I can just find the source images. I have this in a video. Actually, I think it's in this one. Oh, maybe not. Yeah, here it is. Hey. Here is a YouTube channel. I'm not saying who it is. Oh, you know who it is. Obviously, it's ICT. You notice this right here? There was a day, it basically in February of 2021, where for whatever reason, he gained 200,000 subscribers in a day. So from this point onward, his channel was like a mega channel, and it had, you know, like people were following it. You think it was purchased? Could be. At this point, it was where you could like make channels about that channel and get a lot of views from it. pretty crazy the way that YouTube works, right? And when does this stop working? Well, it stopped working actually May 2022. Oh, you know what? I was drawing the lines wrong. Okay, so from here. Okay. This how can I show this to you guys? I need to move this over here. Move this over here. Okay. This line right here basically corresponds to this line right here. So as soon as the channel became a mega channel, the strategy stopped working. Interestingly enough, before that, it didn't do anything. It was kind of like maybe random before that. So like a channel being a little popular kind of helps the strategy. Or a strategy being a little popular helps the strategy. But there's a point at which it becomes too popular, it will fail every time. I'll make a video about this, about smart money concepts, where I kind of explain the problems with it and everything. So, this isn't like definitive proof necessarily, but this is a pretty interesting case study where we believe that we have reason to believe that the popularity of a retail trading strategy affected the performance of that strategy. And you should be able to go in and track different retail trading strategies and like the popularity of them and track them against the profitability of them and see that something will start to do well, so it will become more popular, and then once it reaches a certain amount of popularity, then it just starts to fail dismally almost every time. Can a YouTube channel or a Reddit post or you know, a popular trading course impact the way that the market moves? Yes, absolutely. Both theoretically, and we can provide examples. It's interesting because there's like a very quantified moment in time where I stopped seeing ICT content in the suggested feeds. Well, because what happened was at first, so here's the thing that I find really, really interesting is that there's a cycle, and it seems to me that the cycle tends to be about 2 years. So what happens is you get a bunch of new people, they come in, and these new people, they don't know anything about it. So 2 years, you know, in 2022, I was seeing ICT everywhere, and it was so flippin' annoying, but people kept posting it. And why? Because all of the new people, they didn't know any better. And then what happened? Those new people, they got in, they did it for 2 years and all got burned. Now you try and post anything ICT on Reddit and you just get completely flamed, because those are all of the people that got burned on that strategy. Now everybody knows. It's kind of funny because I'm starting to see it shift again with the thing that I've been trying to tell everybody here. So I've been telling people, like, there's only so much information you can pull out of price, and especially if you're day trading, all you're looking at is the price of a single asset, you're probably not going to do very well. Go and backtest these, you know, all of these things that people claim work and everything, like go and backtest it. Because it's so easy to go and back, especially with LLMs now and everything. And now, almost daily on Reddit, I'm seeing a post that is like, hey, I tried backtesting RSI, it didn't work. I tried backtesting this, it doesn't work. Everything that I've tried backtesting on an intraday time period doesn't work. Yeah, because there's not enough edge in that price series for you to get anything. The only way that you're going to find something is pulling in other data. The biggest one being like news. Let's see here. His last tweet, I'm not going to participate on this platform going forward. You're about to see what I told you was coming. Be ready and look up. It's so perfect after bailing the hell out of that Robin's cut shit he put so much emphasis on. Rolled over into a new year a day after his last tweet, and there's no more ICT shit in the feeds. Yeah. Okay, so it's kind of, dude, I feel a little bit vindicated about it, honestly. Do you remember? When was it? I think it was in 2020. It was like as far back as 2020. It was before ICT became a big thing. Okay. And I remember somebody was coming into our chat every day and they were really, really active. And then eventually they were like, well, what do you think about ICT? And then I went and I looked at it and I'm like, I can't believe that anybody would watch this guy. They are obvious. They are an obvious narcissist. It's so blatantly obvious. This guy, he just gets on and he talks forever and ever and ever about himself and how he developed the algorithm that runs the markets and all of this BS, and not actually giving any content. And then he talks on for like 3 hours and doesn't give you anything. I mean, look, we've been here for 3 hours. This has been a very informationally dense live stream. And you might say, wow, Seth, like, you're able to give us really good information. The reason why is because I've done it 1,000 times at this point. I've given this speech 1,000 times, I feel like. It's because I'm just addressing, like, the common misconceptions and things that retail traders don't know about the market that kind of explains why the things that they're trying to do don't really work, right? So I said that, and that guy was so upset, and the reaction that I got from him kind of made me think that maybe it was ICT himself. And then after that, ICT became like incredibly famous, and I'm just shaking my head the whole time, like this is absolutely, this stuff is nonsense. Doesn't work. He's lying. Man, you can go back. Like, the funny thing is that, like, it came in, the Reddit trading community didn't recognize him. The futures trading community doesn't know who he is. The Forex community was very familiar with him. Basically, in any of the Forex communities, it's just mentioning his name has been a bannable offense for like 10 years now. And you can go, I tell you what, I'd have to go and find the link again. But the Baby Pips forum basically collected like all of the stuff that they had, like all of the interactions that he had on the forum, and all of the crazy claims that he made, and him being proven wrong, and him trying to justify and explain it away, and all of this sort of stuff for years. So like, if you go and read that thread, it will literally take you all day to read that thread. You probably won't get through it all because it's so exhaustive. It's just like, it's the same thing over and over and over and over again. It's just so crazy. And yet YouTube pushed him. Everybody was like, trying to give explanations for why they should look at it and all these, like, the really common thing is like, well, maybe he is an asshole or he's a narcissist, but if it works, it works. Doesn't work, but okay. Now, finally, everybody understands. And I come back to how does anybody fall for this? I don't understand how a single human being that has an IQ over 90 doesn't watch that and be like, this guy is obviously full of shit. Am I really that different from other people and what I look at that I can see that and other people can't? Because I just can't believe it. All of the signs of narcissism are completely there. And you're telling me that people are just so vulnerable to looking for signs of social proof and the manipulation methods of narcissists that that the average person really does just fall for that? I just can't believe it. I refuse to believe it. It's just so crazy. It's just so crazy. Why? I don't understand how anybody can get through one of that guy's streams. It's so grating to me. It's so weird to me, man. It's so weird to me. I'm feeling better because this past week I've been seeing a lot of things that kind of are like people are figuring it out. Like they're actively starting to question it. It used to be that if you had a thread about technical analysis that it would be like 50 guys trying to explain why they think that their technical analysis works and then me explaining why it doesn't, right? And now you get like 10 guys that are like, nah, it doesn't seem to work. They might not completely understand why, but they're like, nah, it doesn't seem to work. I think it's just kind of like confirmation bias on my part. Like right now, I'm feeling pretty good about where we've been going, right? Like I felt really confident that Donald Trump was going to win. That happened. We've the market, the trading world is kind of starting to understand the problems with these things and moving our direction. Surely I'm going to like fall hard soon though. Did you see so I saw like videos of the debris falling to the ground, which was like one of the coolest looking videos I had ever seen. Really pretty and amazing looking. But I didn't really dig deep enough to really understand a whole lot about like what happened and why. I said that I was going to do programming stuff, but we had too much good discussion, so I guess I'm just doing it afterwards. My plan was like, well, if I can get into it, maybe I can finish the 20 remaining exercises that I have on Rustlings and have that all done with. And then I can spend the rest of the weekend trying to finish writing the next video that I want to make. And so that I can get to that, because I feel like big time behind. I feel that I should already have my own trading platform all ready and packaged up for you guys to start selling it and everything, and that I shouldn't be talking about it at all, that it should just be done. But I don't have the time because I'm watching these kids. Yeah. I think the job search is getting better. I haven't been getting as many interviews, but it does seem like I was able to apply to more jobs this week. They cast the booster again with the tower. Yeah, I did see that part too. Rust is a good language memory safe I learned, but no idea if it's better than C++. Well, so there's a bunch of things. There's weird stuff. Okay, so one of the things, like, is it better than C++? It's kind of like, because there's like big problems with C++, and there's big problems with Rust. But the problems with Rust aren't that like it sucks to use. The problems with Rust are really kind of more like a skill issue. It's kind of like, well, here are the things that we have to do to make a language memory safe, and that kind of results in it's kind of hard to write Rust code that, you know, the way that you maybe want to do it kind of ends up being wrong sometimes. So like the first thing is that if you're going to write Rust, like you really have to know your stuff. And then the second problem with Rust is it's still pretty immature. So like if I'm making a GUI with it, it's kind of questionable as to whether or not the existing libraries that are out there are really sufficient for you to be able to make what you want. I've seen many people say that, you know, like they want to make games, they don't want to do it in C++, so they're doing it in Rust, and then they find that they have too much trouble developing the games in Rust that they're not able to iterate fast enough, and so they go back to something else. That's why there's this guy making another language called JAI that is supposed to, you know, his ideal language that he thinks would be better for game development or something. You know? So it's kind of a complicated thing. And some people might say, like, for instance, if I just wanted to make a platform and, like, the most important thing to me was the features and getting it out to you as quickly as possible, then I could probably write it in C# and already be well on the way to making something. But, you know, there'd be performance and memory issues. But if I'm really like, I'm just going to do absolutely everything correct and I think that I have the skill to just do it that well, I think I can do it in Rust. I think that I'm a use case where I can make it work. I mean, C# is memory safe. Not really. First of all, it's a garbage collected language. But second of all, what I find with C# is that there's all sorts of ways that you can really screw yourself over with the garbage collector that your average developer doesn't realize. And so they make these mistakes all over the place. And next thing you know, your application is using like 60 gigabytes of memory, and you're like, how is it using that much memory? Well, it's because of the way you developed it. But it seems like if you really want something that's memory safe, you want something that is you're managing the memory yourself. It's not garbage collected, but it's memory safe. Rust is pretty much the only game in town. Like there's been efforts to like libraries that will make C++ memory safe and things like that, but I really don't see that catching on. And then there's like JAI and Odin and stuff like that, but they're just not nearly as far along as Rust is. So like the end result is, if you want a memory safe language, you want a new language that's powerful and low level like C++, but is also modern and memory safe, you go to Rust and you just deal with the skill issues and be awesome, I guess. So that's my conclusion. I totally get. So the part of the reason why this is a big thing right now is because the top programming creator, the Primogen, he has been doing Rust for a year or two, and basically decided that he doesn't like writing in Rust and wants to go and do something else. So now he's like looking at these different languages. And I think he does end up just focusing on Zig for a while. I don't know. Like the issue that I'm having right now and going through these exercises and everything is like remembering the syntax is super hard, man. Because Rust has some pretty complicated syntax. I think that I need to get a cheat sheet and start running through and memorizing that cheat sheet every day. Probably. Oh, you know what? I totally missed a comment, like Luigi's last comment. I was kind of like, what happened to him? He disappeared. Oh, well, he asked a question. I didn't respond to his question. That's what it was. Yeah, so if a scalper is looking to get, let's say, 3 to 5 points or even less, why would he need any more data than an intraday chart of the asset that he's trading? Because the intraday chart hardly contains any information that will actually help you get 3 to 5 points on with a positive expectancy over a large enough data set. Like, most of what you are looking at, there is noise. And if there is signal, how are you going to differentiate it? The only way that you can really differentiate it is like, here's this noise thing, and I can say, oh, well, actually, there's this data series that's like this. Okay, so now I know that this move came from this thing, right? Now I can separate out the differences. And I have this other one that's like the, oh, it's like this. Now I know these parts were due to this data series, right? Now I can filter it out, and then what's left, that is like the true noise, right? You just can't do it with one data series. There's not enough edge in there. Like there's one way to say that, like, maybe there's just not enough edge. Personally, I believe that there's no edge there at all. That what you're looking at on a 1 minute chart is so chaotic that, you know, my theory is that there exists no function for which the input is a single 1 minute time price series that is profitable after fees. That's my theory. Don't think it exists. Think that maybe it existed at one time before electronic markets, but I'm pretty sure I'm very, very much convinced that there's just no edge in it anymore. Did you use Udemy to learn? No. So there's a Rust book. So I read the Rust book. And then there's a little project called Rustlings that you kind of, I probably should have done it as I was reading the book, but I've done it after reading the book to kind of review that. Basically it gives you a bunch of problems that like don't compile, and you're supposed to fix them. And that has been my Rust learning. And I would say that the thing that's kind of crazy about Rust is that, you know, I don't know at what point this happened, but the community basically turned into, we think that Rust is the future and we want to promote this language. And so they really took the approach of like, we're going to create all of the resources to make sure that this is a popular language. So the error messages that you get from the compiler are really, really good. The documentation for the libraries and everything are really, really good. The community has made learning resources, all of these sorts of things. So you can do really quite well with just using the resources that the Rust Foundation has made, from my experience so far. Well, I tell you what, I was like, oh, we have 15 minutes left, but that last 5 minutes felt like an hour to me. Interestingly enough, by the way, once we said, oh, I think I am detecting a liquidity hole, hasn't really done much since, has it? There was kind of a pullback, and it's kind of like going sideways now. Do you really want to start to make your own software? I do. I guess I am, or at least I'm going to start doing things that go down that path. I don't like, okay, I'm not going to like throw away my Jigsaw subscription anytime soon because I don't know how realistic it is for me to actually do that. You know, like with the time constraints and so forth that I have. But it is something that I'm starting to focus more on. Yeah. If I met somebody tomorrow that's like, oh, I program too and I want to help you make a platform and I happen to have $2 million for us to work for, you know, live off of for 2 years to do this, then I would be all in. No, we're talking about doing all of it in Rust. We're talking about doing all of it in Rust and making it so that there's Python bindings so that you can make all of your indicators and strategies in Python, even though the platform is Rust. That's kind of like one of the key motivations behind it. And the other one being having a platform that gives us a little bit more control and is built more for handling data. So that, you know, it's easier for us to plug in machine learning models and so forth with it. Right? That's part of why you want it to be Python. So that if I want to do that in NinjaTrader, I have to pull in another library, which might make it difficult for me to be able to give that library to other people, right? And then it has to be one that's compatible with the version of C# that NinjaTrader is using at the time. And then it's going to be a model that's maybe not as good, or as, you know, there's not as many options as what you might get with PyTorch or whatever the deal is, right? But if I do it in Python, it's all dynamic and all of these sorts of things. I don't have those problems. Okay, you have to have maybe somebody's providing a code that requires certain libraries to be involved. Well, we can just make the application know how to utilize the Python environments and stuff. CUDA knows how to use CUDA and everything and handle all of those things for you. Can we go through the process of how to use machine learning? I think so. Yeah. I think that probably around the summer is when we might be able to dig into that more deeply, depending on what we have going on. But like at the moment, we're kind of trying to collect data, and I kind of like changed some things. So like I think that it's really like I only want to use the data starting from the beginning of this year. But then we want to have at least two expirations of data in there, and then I will probably revisit some of my my robots that are based just on order flow, and then after that I will probably I think I still want to do TabNet. After that, I want to see, okay, if I import all of these data series into TabNet and do a couple of other things, can I utilize the machine learning to create a better strategy? Yeah. Did you try out DeepSeek? No, I don't know what that is. Is that something you've told me about before? Okay. Mixture of experts, but that's an LLM, isn't it? Yeah. So like the thing is I'm kind of Tabnet is about tabular data. So Tabnet should be better at, I have a spreadsheet with a bunch of different columns, and then it's able to look at those different columns and sort out which columns matter when and all of these sorts of things to achieve some goal. So that's why I'm interested in Tabnet. It's not really an LLM. After we'd go through that one, then maybe the next one would be to try and recreate this study where they convert changes in the order book to tokens that are passed into an LLM and try to find short-term signals from that. Okay, well, anyways, the most important thing right now is to get out another video in January, prepare videos for February, try to line up another interview, and get another day job. So focus on that. I was thinking about this Primogen thing because one of the things that people are saying is like, oh, he's changing from Rust to Zig, and now he's changing from this to this, and that's just engagement. Once the YouTube engagement goes down, then you'll probably switch to something else, and all of these sorts of things. And I don't really think that that's it. Like, I mean, maybe it plays a factor in there, for sure. But like, if it was just about engagement, wouldn't he do like the most popular? Basically, he would just teach JavaScript stuff, right? And he would switch between different JavaScripts. Like that's what Theo does a lot of, isn't it? Anyways, no. My understanding is that the Primogen has solved ADHD like I do. That he's medicated to some degree, and he's developed all of the strategies and everything, that he's really good at it. But I think that one of the things that solving ADHD doesn't solve is like a desire for novelty. So especially when you're talking about things where, it's all you and just what do you enjoy doing, you have to switch between stuff to keep the novelty going. And that's probably what he's doing, right? And for me, I'm kind of more like, I'm not just doing it just for kicks and giggles. I mean, I want to enjoy it, but there's also very specific goals, and I've basically trained myself to just push through it. But like, reading the rest book was not easy. It was not easy coming in and reading it every day. Cleaning these rustlings is not easy. That stuff's hard. And I honestly, when it happens, I think you can see it on my face that I just go into this like battle mode where I'm just gonna get the flipping thing done. And if you've been watching, I've been like that a lot lately, because I have no choice, right? I have to find a new job within a certain time period, because or otherwise, I will have to like sell my house or who knows what. So that's where we're at. And I don't have the luxury of doing that. Like, let's just go and follow whatever kind of interesting thing we want to do today. Unfortunately, that's not my lot in life. Anyways, I will get going, guys. I will see you next week. Man, dude, do not miss next week, because we're going to have so much to talk about, man. We're going to have so much to talk about. I really think that we're going to be surprised by how markets react. Like, you might be able to say, yeah, we're going to sell off of that. Like, it's going to be bad for the market, or you might be able to say it's going to be good for the markets. But I'm going to bet you like that the way that it is and the way that it plays out and every is going to surprise you. It's usually the way that it works out, and especially in a situation like this. So it's going to be really, really surprising because there's chaos involved. Okay, so see you guys then. Stay excellent.